If you are a long-term minded investor, you may enjoy the following presentation on Lanxess, a German specialty chemicals company, by Stuart Mitchell of SW Capital in the UK. Lanxess's business has improved in terms of its long-term quality, yet the stock price has sold off significantly due to energy cost pressures in its German home market. This is a company that's somewhat known to the MOI Global community, having been presented before by Jim Zimmerman and Samuel Weber. I do believe this presentation makes a good case for why this may be a great time to look at Lanxess if you are a long-term oriented investor and can look through the short-term negative news.
I think the MOI Global is just the best of all the value investing conferences that we know of. We're asked to speak at many, and yours is really just a cut above everything else. And for us, it's a great honor to be able to speak. So what I wanted to do, John, today was to talk about Lanxess, and this is a really interesting idea. So it's the opportunity for us, in a nutshell. And I'll go into the detail in a moment. This is a chemical company that's been through profound change, and so that creates an opportunity for us because the analysts, we think, haven't properly understood the nature of the business today. It's a chemical company which has too much debt, but we think there are ways in which they can reduce the debt, and actually the debt is termed out in a surprisingly, in inverted commas, safe way. And the opportunity for us really came, in last year, when there was the very significant chemical inventory squeeze reduction across the whole network, and of course, like many other chemical companies, Lanxess saw a dramatic reduction in their profits. But for us, it really created the opportunity to be able to buy what we think is a very interesting collection of assets with a debt profile which is, in our view, easier to manage than many of the analysts think, and where, in our view, there's dramatic upside. So just on this page here, on page two, a little bit of background for you. And some will know this already, but Lanxess is an unusual creature. It was created back in 2004, as far as that ago, when Bayer decided to basically spin off what they thought at that time were their more commodity chemical activities into a second group. And if we turn to page three, it's quite interesting what I've done there, just to give you a bit of an idea how it looks today. So it's a smallish chemical company, but it's as you can imagine, it's very diversified. 35% in America of its business, 16% in Germany, 30% in EMEA ex Germany, 19% in Asia. And but the really interesting part now is just how different the group is today from the business which Bayer span out back in 2004. And I'll go into this in a lot more detail, but just to get the big kind of top overview: 37% now is in consumer protection, 36% is in specialty additives, and arguably the only part which is still more cyclical, more sensitive to the economy, is advanced intermediates, which is now a much smaller 27% of the group. So if we look on page four, quite interesting. So what did management do to change the character of this group? And there were really a number of very important deals, and particularly some key deals which have happened in the last 5-10 years. And for us, the really important first deal was when they bought Chemtura, which is a flame retardant company, and this is a really nice specialty product, high market shares. Its pricing is very resistant in a downturn. There's all sorts of opportunity for new technology development in order to keep your pricing. So that was a really important deal. And then the next thing they did was they sold, and you may have heard this, it was quite a big deal. They sold their rubber business, Lanxess, in 2018. And again, rubber's a difficult area because although they had quite a high market share, it was just very difficult to very difficult, as it were, to innovate and to create new product where they could make margin. And it made more sense for somebody else to own that business than for Lanxess to keep hold of it. And then the next really nice little deal was they bought the microbial unit of IFF back in 2022. And again, this is a really nice specialty chemical, high market shares, good margins, all sorts of opportunity to develop new technology and to keep the margin high. And the last part, which is really key, and we'll talk a lot more about this later. It's very complicated, but the engineering materials business of DSM and Lanxess high performance, so-called high performance materials division, which in our view was one of the more cyclical areas of the company, was merged together, and Advent came in as a shareholder. So it's a new business called Envalior, 41% owned by 41% owned by Lanxess, and the remainder owned by Advent, the private equity group. And the idea is crunching together these two businesses where there's a lot of overlap and taking out cost. And it's quite an interest. It's quite important because we think at some stage, and I'll talk about this a lot more later, but at some stage this business could, there's a put actually to Advent, and back in 2026, and if Lanxess exercise the put, it will further dramatically reduce debt. So quite nice, that little chart below. If you look at those that pie below, it just shows you really how the shape of the business has changed. And as you can see, back in 2017, it was a much more of a how do we call it, more of a commodity type chemical business, particularly polymers, these kind of businesses, advanced intermediates, quite difficult to innovate with new technology to be able to create product with with high margin. And if you look how the business has transformed now, we like to think it's almost 3/4 in specialty chemicals, and only a quarter in the more commodity areas. And all this is incredibly important because, of course, when we're trying to model it, and I'll talk a lot more about this in a minute, but when we're trying to model this, most of the analysts we think are modeling a recovery or over the cycle margin of Lanxess, which in our view is just too low. It reflects how the business used to be 10 years ago, but not how the business is today. And our guess is over the cycle, the business will generate operating margins which will be 200, 300, 400 basis points higher than what the analysts expect. But anyway, turning to the opportunity, where did we get this opportunity? And if we look on page 5, as for many chemical companies, it was a really challenging year, 2023. I mean, the numbers are kind of extraordinary, but it was experienced by BASF, all the major chemical groups. And I mean, a part of it was a marginal slowdown in the economy, but the main thing was inventory reduction. So it was the build-up of inventories post-COVID, and then this bringing inventories back down again in 2023. So sales fell by 17% and profits by 44%. But what's really important for us is, even in a brutal year like this, and our view is that if the business had the same kind of shape as it had 10 years ago, they probably would have lost money. I think it just gives you an idea of how much better quality the business is today to how it was 10 years ago. But the really crucial thing is they managed to generate operational free cash flow, 270 million operational free cash flow. And they also released quite a significant amount of cash by reducing working capital to sales. And of course, the last part was, and I'll talk a lot more about this, but they received the first payment for Advent for their share in this kind of joint venture created group with DSM. So quite interesting. In a year like this last year, EBITDA 45%. You can see in that bottom left-hand box, they managed to reduce debt by 35%, but it's still a lot of debt. It's 2.5 billion of debt, and the market cap is somewhere near to 3 billion. So it's I mean, there's danger, and we never really like to have companies where the debt is as high as it is relative to the market cap. And if you just look on the next page, page 6, this just shows you in a little bit more detail how the debt's come down, where the equity ratio is today 47%, but it's still a little bit too high. It shows you the net working capital, how that's come down. But I think the really crucial thing to understand is the debt profile, and I've laid this out on page 7. So they did their work, and as you can see on page 7, what they did was they when there was the opportunity, when interest rates were very low, they termed out as much as the debt as they possibly could, and this debt is very covenant light. So we've got quite a big chunk of debt, but what is really comforting is the debt is termed right out. So we've got large slugs, 2025-26, but they're manageable slugs, which take us all the way to 2029. Now, John, since I've done this chart, we're actually in a slightly better position than we just got the news in the last few days. So Lanxess have actually sold this business called Urethane, and they got 500 million for it. So the debt is now down to about 2 billion, just under 2 billion. And and they have short-term credit facilities. So they're covered. Certainly, they've already managed to refinance 2025, 2026. So we don't have to worry until 2027. And but our guess is the debt is already manageable enough, as long as the cycle is reasonable and the business isn't losing money. There's a manageable load of debt today, but our guess is, and I'll talk a bit more about this in a minute, but our guess is the debt we think will be substantially less than where it is the 2 billion today. So we've got quite a nice maturity profile, very manageable. They took advantage of low interest rates and to put this to spread out the burden, push the burden out as far as they possibly could, and that gives us a lot of comfort. So if we turn now to page 8, and so clearly the business has got to recover, and so they can start really generating operational free cash flow to get the debt down and to be able to start paying out a dividend again. So we think we've come somewhere near to the bottom, and the last 2 quarters are really very encouraging. We're already seeing a recovery in consumer intermediates. Agro, as you know, many of you who follow the sector, remains very depressed, but it's not getting any worse. And our guess is it's not so much about underlying demand, it's more about inventory reduction right across the chain. Of course, as interest rates go up, it costs you more to finance your inventories. So most companies have done whatever they can to pull their inventories right back to as low as possible. And the other really interesting thing is with the cost cutting which they introduced when the company faced problems last year, and all the work they've done on plant optimization, they managed to bring the plant utilization from the mid 50s% back at the end of last year to something around 70% currently. So we're in a really nice position if the volume continues to recover. And remember, we're still 25% off where volumes were 2 or 3 years ago. Then the business should really start to generate significant cash flow. So if we go to page 9. I was wanting to have a bit of a stab at valuation. So how the hell do you value this business? So, and the thing we tried to do is we've looked at where the net debt is today, and as you can see the top left-hand chart, we had 2.5 billion at the end of last year. We've got the urethane sale now, which has been done, 500 million in. We think, now this is a very difficult one, but we think this year they'll probably generate free cash flow about 60 million. So we're somewhere around to 1.92 billion of debt. So it's quite, we think it's a manageable amount in the context of the business. The market cap around 3 billion, so it starts to get manageable. And what I wanted to do is just have, and this is forgetting about the put on Envalior, which I talked about earlier, and we'll go into that later. But what I did was just 1 or 2 little scenarios, how things could develop. So in the first scenario, I said, well, let's say over the cycle, average, they make a 15% EBITDA margin. And let's just say revenues don't recover at all. And that's eminently possible with the cost-cutting measures in place, with all the work they're doing to improve efficiency. And what we did is we valued that EBITDA, 15% EBITDA margin on last year's revenues. We valued that at 6 times. And that's a pretty conservative multiple. What we did is we looked at BASF's multiple today on recovery earnings 2 or 3 years out, and we put a discount at that. So on that basis, we get an implied equity value of 4 billion, and so we think we've got upside in the share price of 200%. Where it starts to get more interesting is so let's look at the 15% EBITDA margin, and let's look at revenues recovering to where they were before 2023. Then you get a recovery and applied equity value of almost 5 billion and a 220% upside. So it starts to get more interesting. And then the one which I personally think is most likely, and we've done a lot of work going through every single product line, seeing the kind of margins those product lines made when they weren't part of Lanxess, but when they're in different groups, before Lanxess purchased those businesses. We think they should be able to make an 18% EBITDA margin across the cycle. And then I've done numbers on, let's say, revenues recover back to where they were before 2023, and then we get a 3 times upside in the equity. So I think there's a really, really nice opportunity here, and it's a kind of business, John, that we love because it's difficult to get your head around. It's a very complex. There's been a lot of purchases, acquisitions of businesses. To really understand it, you have to go through line by line to work out what you think the profit margins could be in a more normal economy, and then you have to think very carefully about the debt, look at the terming schedule, look at the covenants, and get comfortable that the debt load is manageable. And then when it gets very, very interesting, John, is if we go to the last page, page 10. So they have this funny business in Envalior. So Envalior, it's a private equity creation. It's got a lot of debt inside it. It's 41% owned by Lanxess, and the rest by Advent. And the idea was to bring this DSM's business and Lanxess business together, and there's a great opportunity to cut costs. Now, what's interesting here is Envalior is Lanxess have a put option here back to Advent, so they can sell this business on 10 times EBITDA. That's the price, back to Advent. And so the real complexity is, what do we think? I mean, what do we think this put option is worth? Do they think they'll be able to exercise it? What kind of EBITDA do you think they might be generating in 2026? So the real challenge on analyzing a business like this is it's within private equity, so it's really hard to get detail. And what we've had to do is go to Fitch and S&P to find out about all the debt, and we've had to look again at from Fitch, S&P, what the EBITDA and what EBITDA they're predicting over the next few years. So, and because the real question in a construction like this is if there is a prolonged downturn, is the business financially strong enough to be able to survive? Will it need new equity? And our guess is it probably will survive. And we were quite surprised that even 2023, the business managed to make an EBITDA of 150, and S&P and Fitch are expecting EBITDA to bounce back. You can see it in that second box down. Expecting EBITDA to bounce back to S&P hoping for 375, Fitch for 343. And that looks very consistent with, there are similar other businesses you could find. And if you look at the kind of recovery in profits they're expecting, it's very similar to what we're seeing at Envalior. So our guess is the business is amply profitable enough to be able to cope with the interest payments, and they should be able to get through to be able to exercise their put in 2026. So on the kind of modeling we've done, and we've gone back and forwards with the company, and we've looked at what other companies are, the kind of profit which they're expected to generate. We think, not being very ambitious, we think they should be able to exercise their put for something like €1 billion. And quite interestingly, actually, in a chart which Lanxess have just done, just recently announced post the sale of the urethane business, they gave an estimate, a hope kind of figure for what they thought they could get. They could exercise a put in Envalior for, and it's the first time they've done this, and it shows that they're much more confident now, having got through the crisis of 2023, having seen the recovery, of being able to exercise the put. And they agree with the number we have of about 1.1 billion. And of course, what's really interesting about this is it makes no profit contribution to Lanxess because of the debt interest payments. And but if they can exercise this option, it basically halves the debt, takes the debt down to 1 billion. And then you have a company which is arguably one of the less levered businesses within the chemical sector, and would drive the share price considerably further. So we think here, if we get this right and this works out as we expect, we think we've got three or four times upside. I mean, there's danger with the debt, but we've been very, very careful. We've worked very hard on understanding the maturities and the covenants. They've managed to sell urethane, which takes a lot of pressure off the business. Our guess is they should be able to comfortably get through even without exercising Lanxess. But if they do, without exercising the Envalior put, but if they do exercise this, then the upside will be dramatic. So we've been quite lucky on this, John. We bought it a couple of months back. We're making 20%. We were a bit nervous about whether they'd be able to sell urethane or not, and but they managed to do it. I mean, we should have been more confident, really, because there are a lot of buyers for it. It fits very nicely into the chain for quite a number of chemical companies. So they've managed to do that, and that's what's driven the share price. Been behind the first big drive in the share price. So John, I don't know if you had any questions or thoughts.
Wonderful. Well, thank you so much, Stuart, for the presentation and the investment case here. I'm wondering, what are some of the key data points that we should keep an eye on going forward to gauge how the thesis is playing out?
That's such a great question. It's really difficult in this industry because, I mean, it's quite interesting. You know, we've had a lot of talk about the Chinese economy weakening, and you would expect that to have some kind of impact on Lanxess's business, but it hasn't done. And we probably speak to them once a month, John, and to get so we're completely on top of the latest intel on how the businesses are doing. And the recovery is continuing as we would have expected. Agro megals are depressed, but this period of perhaps weaker activity in China doesn't seem to have had any impact on pricing in the industries in which they operate. And I think it's something to do with the severity of the destocking last year. And so there isn't that kind of first phase of destocking that you would have seen in a period of weakness that you might have seen in the past. So we're looking very closely at China activity. We're really hopeful if there's some kind of big fiscal boost, it should have a positive benefit. So we're looking at all the chemical prices in the main areas they operate. We're looking at economic activity as a whole, and of course, you know, the level of interest rates.
That's very helpful. Thank you. And could you talk a little bit about how you see the long-term competitiveness of the businesses, particularly in terms of the energy input costs here?
Great question.
And, yeah.
It's a great question. I mean, the big challenges, of course, European companies have is it's a lot more expensive hiring staff and firing staff, and the whole process of permitting and green rules. I mean, it's basically impossible to set up a new plant in Europe today. You just wouldn't do it. There are so many other places in the world where you can do it more cheaply. But I think if you have the plant and if it's been depreciated, and if you've orientated your business towards specialty chems and you're employing cutting edge technology, you should be able to run a business in Europe profitably. And of course, you know, a lot of your products being sold to local European industries, so you don't have the challenges of transportation, you know, product being transported out of China into Europe. So you should be all right. So what's the big challenge? The challenge, of course, is energy costs. And this is really this is difficult. And clearly, you know, post-COVID, we had this big problem with, you know, a third of Germany's gas came from Russia. And there's been this scramble to find gas from other parts of the world. And we've had this prolonged period of very high gas prices. And we didn't get to rationing, but we had a period of very high gas prices. And on the whole, the Europeans were able to pass this on because their business mix is generally specialty, but it must longer term have an impact on competitive positioning. But John, we're much more hopeful on this, and our guess is this could be that, because you know markets move in such strange ways nowadays. This could be the big macro thing which and I probably should have added this. And what are we looking at macro? But this it may well be the big macro thing which drives some of those large kind of basket investors into buying companies like Lanxess. So of course the response to to not getting gas from Russia any longer was to, and we've had another pipelines which come from the Middle East now, which will be feeding Italy in particular, but also we have these liquid LPG, liquid natural gas terminals which have been set up in the States, and we now have handling facilities in Germany. So there's all that excess gas from the US which can be exported into Europe. So if you look at the forward curve, gas prices are likely to collapse into Europe next year. And that's what we're hoping. We're hoping this is how it works out. There's so much gas which is exported out of America into Europe that we have a glut of gas and prices come down. And of course, gas is the critical feedstock, whatever you look at it, because gas is the marginal producer of electricity. Gas is the basic feedstock that goes into ammonia, and that kind of drives the whole chain for companies like Lanxess and BASF and others. So we think there could be a really nice surprise next year on energy costs. We haven't really included it in our numbers because it's just, I mean, you can see from the forward curve it's going to come down a lot, but we'd really just like to see it before it happens. But you're absolutely, I mean, it's a great question, John, because it's kind of it has been in the past the weakness of Europe. Gas is just too expensive in Europe, or has been too expensive.
Well, thank you very much. Perhaps just one last question from me. I would love it if you elaborate a little bit on how you see the quality of the management team here.
Another really nice one. So we got to know Matthias very well, the new chief executive, and he's an interesting guy. He comes from a finance background, and what's really impressed us about him is just how determined and absolutely focused he is on restructuring and turning the business around. So I would say, of all the chemical companies we follow in Europe, he was the first to implement this 150 million cost-cutting program the moment the markets began to come under pressure last year. He was also the most aggressive on bringing down working capital sales. So working capital sales was running at about 25% in 2022, and he brought it rapidly down to 21% of sales in 2023. And the other thing he did was he just got on with it, and he put urethane up for sale. And I think those are all just crucial things to have done, to be right early on, cutting costs, looking at assets you could sell to bring down the debt. And my guess is he's done that more quickly than others. So then the rest of the team, I mean, we've been really impressed by the rest of the team in a slightly kind of unusual way. So what we really like is when we list our companies is that we get, of course, access to the people at the top, but we also like a finance team that's very open and will give us all the information we want, and will answer our emails straight away and reply to detailed questions around debt covenants or whatever it is. And we've just had great access from the team. They're 3 strong in IR, and they've been totally open and straightforward with us from the moment we started to do work on the business. But in a way, John, the real clincher for me is Matthias has bought a lot of shares. So he's been successful in his career, but he's not an especially wealthy man. But he's already bought 2 million or so euros worth of shares, which is a lot of money for somebody in the kind of positions he's been in the past to invest. And we just feel our interests are very much aligned with the management teams. He's one of the when I urge your listeners, John, to go onto the website and listen to some of the quarterly calls, because I think they'd be rather surprised by just how focused and ruthless he is as a manager, which is not typical, I would say, of the German approach, and unusual too that he has such a large part of his wealth is tied into Lanxess shares.
Well, that's wonderful, Stuart. Thank you very much for joining us today and taking the time to share your investment thesis and answer my questions. I'm sure this is of great value to fellow members. I would encourage anyone with follow-up questions to reach out. We'll be happy to facilitate an introduction. As always, truly appreciate your time and insights.
Many, many thanks, John. It's the joy, the pleasure is all mine. It's an absolute privilege to be part of your network. Thank you.